As a business owner, it's important to know your company's EBITDA to better understand how an investor or lender will view the profitability of your business. When you think about your business financials, you're probably most interested in your sales, gross margins, and net income. Basically, what's my bottom line? But that's not how an investor or a lender will view your business. And they'll look at EBITDA, which you won't find on your income statement or balance sheet. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a financial metric used to analyze your business based on its core operations and business decisions. It neutralizes the impact of your company's capital structure, tax structure, and depreciation methodology. These are excluded because they're not the result of core business operations and may change under new ownership. It's commonly used to compare the relative profitability between companies or industries. Investors, creditors, and business owners often use EBITDA as a proxy for cash flow generated by the core business. It's useful for decision making if you want to invest or acquire a business, or if you want to sell your business, or compare your business to its peers. Lenders will often use EBITDA to determine if your company can service its near-term debt obligations. The starting point for EBITDA is your company's earnings, which is also called net income from operations. This is what you'll find on your income statement using standard accounting. The next step is to add back interest expense to your earnings. This step neutralizes the capital structure, which is the combination of debt and equity used to finance your business. If a company has more debt or a higher interest rate, the net profitability will suffer, but it's not due to core business operations. Under new ownership, your business could operate under a different capital structure, which could significantly change its net income. A potential acquirer may obtain financing in different amounts, interest rates, and terms. Next, we add back tax expense. Tax rates are an external factor not controlled by the business operator. Tax expense distorts net income from tax credits carried forward from prior year losses. A potential acquirer may operate the business in a different state or as a different corporation in a different tax rate. Finally, we add back depreciation and amortization expenses. These expenses are added back because they don't represent true cash expenses, and they're purely accounting entries to match the expense of an investment over the asset's useful life. For example, if your company purchased $100,000 machinery, it would not expense that money the day the purchase was made. It would depreciate that expense over the useful life of the asset, so the expenses match the revenue generated by that asset. Depreciation and amortization distort your profitability and cash flow because they're not true cash outflows when they're expensed, and therefore we exclude them from EBITDA. Beyond EBITDA, analysts will often incorporate add-backs or adjustments to calculate adjusted EBITDA, which further deviates from your accountant-prepared financial statements. These exclude add-backs for non-business expenses or one-time extraordinary expenses. Check out PC's video on add-backs for more details on how to identify potential add-backs that could help you defend a higher valuation. Thanks for joining me today, and I hope you found this information useful. And if you like this video, please subscribe to our YouTube channel so you'll be notified whenever new content is posted.